This is the Friday, March 28th, 2014 version of the Market Plus segment. Joining us now is Alan Brugler. Alan, welcome back.
Hey, great to be here.
We've got a lot of questions from producers, not surprisingly, as we head into this weekend, about what to do before the report comes out on Monday. How do we prepare corn, soybean growers and wheat growers before we get those numbers out Monday? What are your thoughts?
Well, number one rule is don't put all your eggs in one basket. I know there's a tendency for some people, it's either the right decision, it's the wrong decision, but the reality is the market is a continuum. And you've got this year, you've got next year, you don't need to take that much risk. So we think you have to look at your situation and say, okay, how much cash commitment have I already made, old crop and new crop? Am I undersold? Am I behind? We've had a pretty nice rally since January. All right, we've had 2 months rally since the last grain stocks report. Now we have another grain stocks report. What's the odds of getting a similar rally after this grain stocks report?
Yeah,
probably not that high. So that says maybe reward the market with some cash sales if you haven't. We did a little bit in the last week here just to capture some of the gains that we've had, but we've still got 20% of old crop left and quite a bit of new crop. The other thing, of course, is put options. This report is has a reputation for being a big mover. A lot of limit moves out of the March report, particularly in corn side. So you do have some downside risk that you ought to protect. It's been pretty popular to use the short-dated new crop options. Those expire they're May options, they expire at the end of April. So that would provide you new crop protection through both this report and the April USDA WASDE report. For a lot less money than buying a December option would. They also are higher gamma, which means if the market goes down, they will increase faster. They'll make more money than the Decembers will. Now, the flip side of that is if the market rallies, they'll go to zero very quickly. But we think that's a key part of it, is having some kind of a price floor. You can do a minimum price contract with an elevator to accomplish the same thing. Soybeans, very similar situation. We've had a nice run up from where we were. They probably have more upside if we don't have the acreage or don't have the stocks, just because we're already tight S&D wise on them. But again, we're short November futures on only 10%, and then we've got some short calls above the market at 1240. Thinking that any rally is not going to be a huge one, but bottom line is you look at your own situation. Do you have enough coverage? What's your ability to sleep on Sunday night? If you're tossing and turning, maybe you need to do a little more than you've done.
Time to get up and make some phone calls.
Yeah.
All right. Now, one of the topics we didn't get a chance to discuss on the show, it's been a rally past 4 weeks, is the cotton market. We're up again this week. What's driving us?
Well, it's kind of puzzling in a way. This is the market that has the worst supply and demand situation globally, and we keep going up. And it's a hopeful sign if you're a corn, bean, or wheat guy that maybe there's more to go yet, because if they can do it in cotton with all that cotton sitting around, why can't we? Essentially, what's happened is U.S. stocks are tight. We've been fairly successful exporting the cotton that we have. And then USDA came out with their annual Jennings report and showed that we actually had less production last year. This was the final report than what USDA had been using in their balance sheet. So that tightens up the ending stocks even further for the April crop report. And so that's added more fuel to the fire and got cotton up. The wild card is China. China is the one that's holding over half of the world ending stocks in cotton. They know they've got a problem. They're doing various things to try and change that situation. The rumor this week is that they were going to only issue import permits if you agreed to buy 3 times as much out of the reserve. All right. Again, I don't have the specifics on this,
sure.
But the idea is, okay, you got to buy 3 cargoes worth of domestic stuff in order to be allowed to buy 1 cheap one out of the U.S.
Right.
So if that happens, of course, our exports to China are going to go down.
Yeah, and now there doesn't seem to be a whole lot of concern about the Chinese economy slowing. I mean, as we've seen in cotton, in copper, and some of the other primary purchases made from China, cotton's really been unaffected.
Well, you have to remember, though, most of the Chinese cotton use is for export. You're bringing it in, you're running through the mills, you're making clothing, and you're sending it to Europe or the U.S.
Back out it goes.
And other items. So, yeah, there is obviously domestic consumption for 1.3 billion people, but it is very heavily export dependent. So in terms of Chinese cotton consumption, it tends to be more a function of the U.S. and EU economies than the Chinese.
All right. Now, one of the topics that, when we ended the show, you left the comment as hogs limit down Monday morning. Would you like to expand on that a little bit? Talk to us a little bit more about what you see in that report and what to expect as we head into this next week.
I think I said maybe limit down.
Right, maybe.
Or
you bet.
Perhaps.
You bet. We got to get ratings.
But the key point is it was a surprise. We've rallied based on a perception of very tight hog supplies. The USDA numbers say that they're not as tight as the trade was anticipating. Now, there'll be some people that will insist USDA miscounted. But technically, we had rallied to an extreme level, several standard deviations above where they ought to have been. We had a corrective sell-off as some of the longs took money out. Then the shorts took their money off the table before the report. We ended up nearly the contract highs. So the market was very vulnerable to a sell the factory action, and I think we're probably going to get one here. I will point out that one of the reasons for the high prices is to ration exports, to try and get the pork exports down. And they've been running 20 to 30% below their 4-week average for the last 4 weeks. So that part's been accomplished. And of course, that has an implication too. So if you suddenly have more pork production and you've killed some of the demand off, that's a bearish factor. So
corn market 2012 into 2013.
Yeah, exactly. So I think you have to be a little bearish here on the hogs. The longs made a lot of money. They may try and defend it, but if I was a bull that had money, I'd see if it dropped $3-4 first, and then try and buy it.
Okay. Now, do you see any sort of spillover effect as we look at the other protein markets if we go limit down over this next week?
Yeah, if hogs start to take a hit, now again, it's futures and cash both. Right. We have seen an interplay between the box beef prices and the hogs. Beef rallied first. It corrected, thinking the retailers are going to feature pork, and then pork started to get really pricey, and the retailers backed off of that, and that gave us a secondary spike in the cattle. So packer can only pay what he can get for the meat, and again, we're probably going to get into some bigger cattle numbers here. So yeah, if the hog thing starts to come down, it'll pull the beef down, and you'll see those cash prices start to pull back, which is what the futures and cattle are already anticipating.
All right. Now we've got one final question as we're talking about soybeans and our demand as we go forward. John in Columbia, Missouri is curious, as we build demand for diesel just in America, will biodiesel become more widely available? I mean, that's one of those things that we heard a lot talked about when the the rule change was proposed. Is that going to be a major impact on soybean, or what would soybean prices do to the availability of biodiesel? Well,
I think obviously if you produce more biodiesel, it'll have to find an outlet. It'll have to find a place to go, and there'll be money to be made. The problem right now is we can't afford to produce the biodiesel without the subsidy, which expired last December. So more of the biodiesel right now is being made from animal fats and other waste rather than from soy oil than what we could be doing.
Okay.
So yeah, it's kind of a catch there. If we need diesel prices to be higher to or soybean oil prices to be lower to make it work without the credit.
Okay. And we don't see either of those things happening anytime soon.
No, there's been some action in terms of some of these tax bills to try and get the credit reinstated, but I'm not aware of anything that's in the works immediately.
All right. Well, thanks for taking the time to be with us this weekend, Alan. Really appreciate it.
My pleasure.
And thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and we'll continue to get expert analysis right to you. Thanks for watching, and have a great week.